Let's move on. Let's talk about options trading. What we are going to do in this section is begin to build the foundation of what an option is, what types of options there are, deciding to buy or sell an option, what the different position in options are, and why we trade options. So, what is an option? An option is a contract that gives its owner the right, but not the obligation to buy or sell an asset, like a stock at an agreed upon price and date in the future. Let's take a moment and talk about what makes this definition confusing. The word contract sticks out immediately. The reason why the word contract sticks out is because as you begin to trade options, it is going to feel like you are buying and selling stock. If you allow the word contract to confuse you, it's going to make things more difficult as you allow certain aspects of option contracts either expire or buy and sell them. The right, but not the obligation, is also very confusing because although buying and selling options does give the individual certain rights, they are rarely utilized. Now, we will discuss those rights, but we are going to also discuss what normally happens when you buy and sell an option. People tend to use options for income, speculation, and hedging risk. Let's start with income. In today's market, it is very difficult to find a safe way to generate any income based on interest rates. Speculation is one of the main reasons individuals will purchase an option. And hedging risk tends to be used by portfolio managers and individual investors that have positions in stocks that are looking to protect their portfolio. Next, let's talk about the anatomy of an options contract. In this section, I'm going to read the definitions and then we are going to talk about them specifically. The strike price. The strike price of an option is the price at which a put or call option can be exercised. It is also known as the exercise price. The expiration date of an option is a contract that lasts date on which the holder of the option may exercise it according to its terms. The option premium is the total amount that an investor pays for that option. It is the max loss for the buyer and the max gain for the seller. Let's talk about the strike price. The strike price is an extremely important aspect when deciding on whether to buy or sell an option. The strike price is the price at which the person purchasing it or selling it feels the price of that stock will be or will not be in the future. It is like guessing or, after doing extensive research, assuming that the stock price is going to be above or below the selected strike price in that trade. The expiration date. The expiration date is also extremely important because it plays a critical role as to what strike price you will select. If you select a strike price that is close to what a stock price is trading, and you give yourself an extended period of time, for example, 6 months, there is a better opportunity and a better chance for that stock to move in the direction you need it to because you have more time for that to happen. If you pick a shorter expiration date, you have less time in order for that stock to make the directional move you need it to make. And then the options premium. This is one of the main aspects as to why most option beginners who start to trade options look to buy options because you can purchase them at a very low price with the chance of making an extremely high rate of return. The problem with this is that most options either expire worthless, and as we discussed earlier, the emotional aspect plays a very important role when deciding on how much to pay for an option. And utilizing the prior two important pieces, it makes buying options difficult to make a sizable gain or a gain that is required for your trading plan. And the trading plan is something that we're going to discuss in more detail, but we're also going to discuss it as the slides and the course goes on. The term option buyer refers to an investor that pays a premium to the writer of an option for the right but not the obligation to buy or sell the underlying asset. In simple terms, when you buy an option, whether it be a call or a put, you would like the stock, in this case we're going to refer to Apple more often than not, to go up or down within the time frame that you selected, above or below the strike price you selected. So let's think back to what we just discussed, the strike price. Where do we think Apple will be in the future? Do we think it will be higher, and by how much? We think of the expiration date. In what amount of time do we believe Apple will be higher or lower? And then you have the option premium. This sometimes is as simple as what can we afford and what we would like to spend. For every buyer, there is a seller. An option seller receives the money from the buyer, and being an option seller, you want the stock option contract you sold to go down in value and eventually expire worthless. There are aspects of selling options that give the option seller specific advantages over the option buyer. What the option seller trades for those advantages is certain upside gains. The option seller receives money upfront from the buyer. This is why selling option for income is such an attractive to generate monthly income to pay your bills. Let's look at the stock exchange. In our examples, we can use either the NASDAQ, the New York Stock Exchange, etc. Tiffany, an investor. Jack, another investor. Tiffany decides to sell an option to Jack. Jack decides to buy an option. Let's discuss in simple terms what is taking place. Tiffany believes that selling this option is either going to bring in income, is for hedging risk, whereas Jack is buying the option to speculate on which direction the stock is going to move. Today, Jack buys the October 31st $400 strike price call option on Apple stock for $10 per contract. Apple shares have a current market price of $390, and the option has 6 months to expiration. In scenario 1, we are going to look at Jack holding this position until maturity. At maturity, the price of Apple stock at expiration is $420. Jack exercises the contract, allows it to expire, which prices Apple shares at $400 per share and earns a profit of $10 per contract. Jack paid $10 per contract. Therefore, he has realized profits above $410 per share of Apple stock, thus giving him a $10 overall gain in his position. I read that slowly because this is a lot of information to take in. But let's break it down into more simple terms. At some point in time during October, Jack felt that Apple was undervalued and thought to himself, I believe within 6 months, Apple is going to be above $410. Could be $420, could be $500, it may well be $600. But Jack believed that it was going to be higher than $420 per share. Therefore, he felt $10 per contract was a fair price, paid the $10 per contract, and allowed the position to continue to play out. At the time of maturity, Jack has a $420 strike price. After adding in his $10 per contract cost, he has a realized gain of $10. With all of this being said, I think it's important to note that option buyers tend to close positions out when they are favorable, or, as we have mentioned in the past, tend to close positions out when they are, according to their trading plan, giving them and earning them the rate of return they are expecting or that their trading plan requires, or they have reached the threshold of losses that their trading plan also requires. Let's look at scenario number 2. Jack buys the October 31st $400 strike price call option on Apple for $10 per contract. Apple shares have a current market price of $390, and the option had 6 months till expiration. The price of Apple stock at expiration is $380. Jack exercises the contract with price of the shares at $400 per share, thus leaving Jack $20 below the strike price he selected. Theoretically, Jack would take a 100% loss as he paid $10 per contract and the price of Apple closed $20 below his strike price. So he paid for an option that, if he allowed to go to maturity, he would have lost the complete and total investment. Again, talking about the trading plan, we would need to look at whether or not Jack held that to maturity, but Jack would take a $10 loss per contract, thus realizing his total loss. Thank you for joining me in this section. We will be moving on to the next session. I appreciate it. Please feel free to reach out to me. I will be available for questions. Email me. I usually return emails within 12 hours of receiving them. Thank you.